Good evening, and welcome to our market coverage for Monday, March 9th, 2026. Curious, tonight's report centers on a production disclosure from the world's largest primary silver mining company that analysts say carries significant implications for global silver supply, and on the price action that unfolded in precious metals markets earlier today. Thoughtful, the two developments, taken together, are being examined by market observers as a reflection of a deepening divergence between paper-based silver pricing and the physical supply reality emerging from major producing operations worldwide. Silver opened the Asian session on Sunday night at $87.90 per ounce. Within 90 minutes of the New York futures market opening on Monday morning, the spot price declined from $87.90 to $83.04. Analysts note that the move occurred without a corresponding news catalyst, Federal Reserve announcement, or identifiable geopolitical trigger. The decline reached a low of approximately $83 per ounce during the session before partially recovering. By the close of Monday trading, silver was quoted in the vicinity of $86 per ounce. Against the backdrop of that intraday price movement, Fresnillo plc, traded on the London Stock Exchange under the ticker symbol FREEZE and identified as the largest primary silver producer in the world, released its full-year production report. The disclosure, contained on page 14 of the report, revealed that Fresnillo's total silver production for 2025 came in at 48.4 million ounces, compared to 56 million ounces in 2024. That represents a year-over-year decline of 7.6 million ounces, or approximately 13.5%. The company attributed the production decline to structural deterioration in ore grades at its flagship mining operations, specifically identifying the Fresnillo, Saucedo, and Cienega mines as experiencing what the report characterized as ore grades in structural decline. The Fresnillo production report is being analyzed alongside a significant move in crude oil prices. Brent crude closed at $119.70 per barrel, representing a 38% increase from levels recorded 6 months prior. West Texas Intermediate crude is trading at $116 per barrel. Diesel fuel, described by mining industry analysts as the primary energy input driving extraction, crushing, and processing operations, is trading at levels last seen during the peak of the Ukraine war period in 2022. The intersection of declining ore grades and rising energy costs forms the foundation of tonight's supply analysis. To understand the economic significance of the ore grade decline disclosed by Fresnillo, it is necessary to establish what ore grade means in practical mining terms. Ore grade refers to the concentration of the target metal within the rock being extracted. A high-grade silver deposit might yield 200 grams of silver per ton of or processed. A lower-grade deposit might yield 60 grams per ton. The practical consequence of that difference is that a mine operating on lower-grade material must extract, transport, crush, grind, and chemically process approximately 3 times as much rock to produce the same quantity of silver. Every stage of that expanded processing cycle consumes additional diesel fuel, water, chemical reagents, and mechanical equipment wear, all of which translate directly into higher per-ounce production costs. The report presents a baseline cost calculation using publicly available mining industry data. The average all-in sustaining cost for a mid-tier silver miner, encompassing labor, energy, equipment, processing, refining, and corporate overhead, stood at approximately $22 per ounce when oil was trading at $70 per barrel. Energy inputs are estimated to represent 30 to 35% of total mining costs, depending on the specific operation. With oil having moved from $70 to $119 per barrel, a 70% increase, the energy component of mining costs rises by a corresponding amount. Applying that energy cost increase to the all-in sustaining cost baseline produces an incremental cost addition of approximately 21 to 24%, bringing the revised all-in sustaining cost to approximately $27 per ounce under stable or great conditions. However, the report notes that ore grades are not remaining stable. Fresnillo's disclosed 13% decline in production efficiency means that miners must process significantly more material per ounce of silver recovered. Factoring in the additional diesel consumption, equipment utilization, and processing costs associated with that or grade deterioration, the report calculates that all-in sustaining costs for large efficient producers have risen to a range of $32 to $34 per ounce. For smaller mining operations in politically unstable jurisdictions, or those running older equipment with higher baseline labor costs, the report states that current production economics have moved into loss-making territory, meaning those operations are generating negative margins on every ounce of silver extracted at current paper market prices. The report provides a specific illustrative example to make the cost dynamics concrete. A hypothetical silver mine in northern Mexico producing 10 million ounces annually at an ore grade of 120 grams per ton is used as the reference case. If that mine's or grade declines to 90 grams per ton, a 25% reduction, maintaining the same 10 million ounce annual production target requires processing 25% more ore, increasing total ore throughput from 10 million tons to 12.5 million tons per year. Every piece of mobile equipment operates at 25% higher utilization. Every fixed processing facility runs at 25% greater throughput. Monthly diesel consumption increases from 50,000 barrels to 62,500 barrels. At a diesel price of $130 per barrel versus the prior year level of $70 per barrel, the monthly diesel bill increases from $3.5 million to $8.1 million. An incremental increase of $4.6 million per month, or $55 million per year in fuel costs alone. Adding incremental maintenance, labor, and equipment replacement costs associated with higher utilization rates, the report calculates that the per ounce all-in sustaining cost for that operation rises from $24 to $37. At an $86 paper silver price, the profit margin on that operation is cut in half relative to prior year conditions. The report then addresses the rational corporate response to that margin compression. Mining company management teams and chief financial officers facing shareholder pressure in a deteriorating margin environment are described as having a clear set of incentives to reduce production at higher cost mine sections, idle lower return operations, extend mine life by reducing extraction rates, and reduce workforce headcount to cut fixed costs. The report argues that when every major silver producer simultaneously faces the same cost structure dynamics and responds with the same set of operational adjustments, the aggregate effect is a material reduction in global silver supply that compounds an already existing structural deficit. The report further states that Fresnillo's situation is not unique among major silver producers. Penasquito, identified as one of the largest silver mines in Mexico, has seen ore grades decline 42% over the past decade. Cannington in Australia, described as having been the richest silver mine on Earth, has experienced ore grade deterioration severe enough that the mine is now on care and maintenance status. San Cristobal in Bolivia is described as being in terminal ore grade decline. The report characterizes these developments not as isolated operational issues, but as expressions of a global geological reality. The progressive exhaustion of high-grade, easily accessible silver deposits that were developed and mined over decades, leaving behind lower-grade, deeper, and more technically challenging resources that require substantially more energy and capital per ounce of silver recovered. The report places the silver mining situation within a broader pattern of ore grade deterioration across the critical minerals complex. Copper production from Chile, identified as the world's largest copper producer, is reported down 9% year-over-year due to the same ore grade dynamics. Lithium production from brine operations in Argentina is reported down 18% due to water table depletion. Nickel production from Indonesia is described as flat despite capacity additions because high-quality laterite ore has been depleted, requiring deeper extraction of lower-grade material. Cobalt production from the Democratic Republic of Congo is being constrained by geopolitical instability and regulatory pressure on artisanal mining. Zinc, lead, tin, rare earths, and uranium are each described as facing comparable supply constraints driven by the same fundamental dynamic: the depletion of high-grade accessible deposits after 2 centuries of industrial-scale extraction. Total global silver demand is reported at approximately 1.3 billion ounces per year. Total global silver production, even prior to the Fresnillo production decline disclosed this week, stood at approximately 1.0 billion ounces per year. That produces a structural annual deficit of approximately 300 million ounces that must be covered by drawdowns from above-ground inventories held across exchange vaults, exchange-traded funds, and private storage systems. The report notes that those inventories have been absorbing deficit shortfalls on a sustained basis, and that the capacity to continue doing so is not unlimited. The industrial demand components driving the consumption side of that equation are described in the report across several categories. The solar panel manufacturing industry is reported as consuming over 130 million ounces of silver per year, growing at 15% annually. Silver paste is used for the electrical contacts in photovoltaic cells, and no commercially viable substitute performing at equivalent efficiency levels exists at industrial scale. The electric vehicle sector is reported as consuming approximately 3 times as much silver per vehicle as a conventional internal combustion engine vehicle, driven by the electronics, battery management systems, sensors, and charging infrastructure associated with electric drivetrains. The 5th-generation wireless network build-out requires greater silver content in antenna arrays and base station hardware than 4th-generation networks. Artificial intelligence data center construction involves extensive use of silver-based components for thermal management and electrical conductivity applications across server hardware. The defense sector is identified as a consumer of silver in missile guidance systems, radar arrays, and advanced avionics. On the investment demand side, central banks, particularly those in Asia and the Middle East, are described as actively diversifying reserve holdings out of United States Treasury bonds and into physical precious metals. High net worth individuals are described as allocating a greater portion of liquid net worth to physical gold and silver in response to financial system instability concerns. Retail investors are identified as a third category of investment demand driven by purchasing power preservation motivations in a persistent inflation environment. The inventory data cited in the report reflects the cumulative effect of sustained deficit conditions across major storage systems. COMEX registered silver inventory, the silver formerly available for delivery against futures contracts, is reported as having declined 62% from its peak level recorded in 2020. Shanghai Futures Exchange silver inventory is reported as down 48% from its peak. Refineries are described as operating at maximum capacity and still unable to keep pace with demand for finished silver products. The report then addresses the COMEX futures market short position in the context of the available registered inventory. Commercial traders on the COMEX, identified as including major bullion banks, are described as holding short positions representing over 400 million ounces of silver in the form of futures contracts. Registered silver available for physical delivery in COMEX vaults is reported at approximately 300 million ounces. The report states that the short position therefore exceeds the available registered inventory by approximately 100 million ounces, meaning that if long contract holders were to stand for physical delivery simultaneously, COMEX registered inventory would be insufficient to meet those obligations by that margin. The report outlines two outcomes it characterizes as the only available resolutions to that structural imbalance. Either the exchange defaults and acknowledges an inability to deliver physical metal against outstanding contracts, or the price rises to a level high enough to incentivize sufficient long contract holders to accept cash settlement in lieu of physical delivery. The report states that under either scenario, the price suppression mechanism associated with the current paper market structure would cease to function. The 1-ounce American Silver Eagle is cited as a retail market indicator of the paper physical price divergence currently developing. Dealers in the United States are reported as quoting premiums of $9 over the spot price for 1-ounce Silver Eagles, a premium representing approximately 10% above an $86 spot price. The report notes that this premium level is directionally consistent with prior episodes of physical supply tightness, and states that dealer premiums are expected to move higher given that mints are unable to increase production rates. Refineries are already at capacity, and primary miners have now disclosed lower output. On the documented regulatory history of precious metals market conduct, the report cites a series of enforcement actions and financial settlements involving major global banks. J.P. Morgan paid a fine of $920 million in 2020 in connection with manipulation of the precious metals futures market. Deutsche Bank, HSBC, UBS, and Barclays are each identified as having been subject to fines and having admitted to market manipulation in connection with precious metals trading activity. The report characterizes the pattern of regulatory fines as having functioned as a cost of business for the institutions involved rather than as a deterrent, given the scale of the fines relative to the profits generated by the activity in question. The mechanics of the price suppression activity described in the report involve the placement of large volumes of silver futures contracts on the sell side of the market during periods of low trading liquidity, specifically identified as the Asian session and the Sunday night futures open, in sufficient volume and speed to generate cascading stop-loss order triggers and margin calls among leveraged long positions. The report characterizes Monday morning's price decline from $87.90 to $83.04 as consistent with this pattern, noting the absence of any identifiable fundamental catalyst for a move of that magnitude within a 90-minute window. The report identifies 3 prior instances of paper physical price divergence as historical precedents for the current dynamic. In March of 2020, the COMEX silver paper price traded at $12 per ounce, while physical dealers were quoting $28 per ounce for 1-ounce rounds due to a complete absence of available physical inventory. In February of 2023, during what the report describes as the banking crisis, paper silver declined to $18 while physical premiums rose to $6 over spot. The report states that the current divergence is expected to be more sustained than those prior episodes on the basis that the underlying cause is a structural supply deficit rather than a temporary liquidity disruption, a condition that cannot be addressed by the issuance of additional paper contracts. The report also situates the silver supply situation within a broader inflation and monetary policy context. The 1,980 silver price peak of $50 per ounce is cited as a historical reference point. Adjusted for inflation using official consumer price index figures, the report states that the 1980 peak equates to $185 in current purchasing power terms. Using what the report describes as real inflation metrics that incorporate housing, energy, and food at actual market prices rather than hedonic adjustments and substitution effects applied in official CPI methodology, the report states the 1980 peak is equivalent to over $400 in current purchasing power. The report presents the current price of $86 per ounce as substantially below both inflation-adjusted historical reference points, and notes that the all-in sustaining cost of production has risen to $32 to $34 per ounce for large efficient producers and higher for smaller operations. The report describes 4 distinct developments it characterizes as the likely progression of market conditions over the 72-hour period following Monday's session. The first is a significant physical buying bid emerging from Asian markets during the overnight session. The report describes anticipated large block orders, specifically citing 20,000-ounce and 50,000-ounce order sizes, hitting spot markets in Hong Kong and Shanghai. Attributed to Eastern institutional buyers it characterizes as actively sourcing physical metal, while Western dealers are described as being under pressure to cover short positions. The second anticipated development is an acceleration in retail physical silver premiums in the United States market. The report notes that 1-ounce silver eagles are already being quoted at $9 over the current spot price, a 10% premium at $86 spot, and projects that premium will increase further given the combination of mint production constraints, refinery capacity limitations, and the newly disclosed reduction in primary mining output from Fresnillo. The report states that mints are unable to increase production rates on a short notice basis, and that refineries are already operating at maximum throughput, meaning no near-term mechanism exists to increase the flow of finished silver products into the retail market. The third anticipated development is a widening divergence between the COMEX paper silver price and the physical spot price being quoted by dealers in Asian markets. The report cites the March 2020 episode, when COMEX paper silver traded at $12 while physical dealers quoted $28, and the February 2023 episode, when paper silver was at $18 and physical premiums were $6 over spot, as precedents for this type of divergence. The report distinguishes the current situation from those prior episodes by characterizing the present underlying cause as a structural supply deficit rather than a temporary liquidity event, and states that a structurally driven divergence is unlikely to self-correct through the mechanisms that resolved prior episodes. The fourth anticipated development described in the report is a short squeeze in the COMEX futures market. The report states that commercial traders currently hold short positions representing over 400 million ounces of silver in futures contracts, against registered physical inventory of approximately 300 million ounces available for delivery, a 100 million ounce shortfall. The report states that if long contract holders begin standing for physical delivery in meaningful numbers, or if Asian central banks begin demanding physical settlement rather than rolling contracts forward, the exchange would face the choice between default and a price increase sufficient to incentivize cash settlement acceptance among long holders. That is our complete report on tonight's silver mining supply crisis analysis. The Fresnillo production disclosure is on record. The ore grade deterioration data across major producing operations has been outlined. The cost structure implications of rising energy prices combined with declining ore grades have been documented. The inventory figures across COMEX and Shanghai Futures Exchange storage systems have been reported. The regulatory enforcement history in precious metals futures markets is on record, and the relationship between the current commercial short position and available registered physical inventory has been presented. We will continue to monitor production disclosures, inventory data, and physical market premium developments as this situation evolves through the trading week and beyond. For the entire broadcast team, thank you for watching and good night.